Welcome back to the show. We have a really fascinating analysis lined up for you today. But right before we get into the heavy machinery of the global financial system, I need to flag something important.
The paperwork.
Yeah, the paperwork. But good paperwork.
Yeah.
By listening to this breakdown and completing the associated quiz, you will actually earn your CPD certificate. So this isn't just about satisfying your curiosity.
Right. It's about ticking a very real professional box.
Exactly. Which is actually kind of fitting, considering how much of today's discussion revolves around the difference between, just ticking boxes and actually getting things done.
That is a perfect segue.
I try. So today we are looking at a stack of research titled Financial Crime Management in the Modern Economy. And I'll be honest, when I first saw that title, I expected a really dry list of regulations.
Most people do.
Yeah, but once I got into the sources, I realized this is actually a story about a massive high-stakes conflict. We are witnessing this structural tension between three competing forces that really, they do not want to get along.
It's the classic trilemma. You have financial innovation, right, which is all about speed, new tech, frictionless movement.
Right.
Then you have financial inclusion, which is the push to get the unbanked access to the financial system.
And the third one is financial integrity.
Exactly. The security layer. Stopping the money laundering, the fraud, the terrorism financing.
And the sources make it super clear that you can't just maximize all three of these at the same time without breaking something.
Okay.
I mean, if you crank up innovation and make moving money instantaneous...
You accidentally roll out the red carpet for criminals.
Right. That is the core friction here. Because we all want the convenience of, sending money across the globe with a face scan or a fingerprint.
But the criminals love that convenience even more than we do.
Yeah. And conversely, if we focus entirely on integrity, like locking every single door, barring every window, we end up shutting out the exact people who need the banking system the most. It's this incredibly delicate balancing act.
And unfortunately, the bad guys are currently very, very good at exploiting that balance.
So let's start right there. The evolution of crime. The reading describes this shift from local crime to digital ecosystems. It's not just that the tools have changed, it feels like the entire business model of crime has shifted.
Oh, it has completely industrialized. In the past, money laundering was a logistical nightmare.
Bavy bags of cash.
Literally. If you had $1 million in illicit cash, you had to physically move it. You had to find a crooked accountant, maybe buy a car wash or a laundromat.
Which is literally where the term money laundering comes from.
Exactly. And you slowly trickle it into the bank. It was slow and it was incredibly risky.
And now?
Now we talk about the speed of crime. With real-time payment systems, a criminal can take that same illicit fund, digitize it, and fragment it into thousands of microtransactions.
Just break it apart instantly.
Yes, and they route those fragments through 5 different jurisdictions, across 3 different time zones, and reassemble them in a clean account on the other side of the world.
Wow.
And they do all of that before you've even finished your morning coffee.
That layering process used to take days, right?
Yeah.
Or weeks.
Sometimes months. Now it happens in milliseconds.
Yeah.
It's terrifyingly efficient.
It really is. But what caught my attention even more in the research was this section on synthetic identity fraud. Because this felt different from standard identity theft.
It is significantly more sophisticated. Traditional identity theft is impulsive. I steal your wallet, I max out your credit cards, I run.
Right.
Synthetic fraud is patient. It's a long con.
The sources describe it as building a Frankenstein identity, which is such a creepy but accurate visual.
It really is. They take a real social security number, often from someone who isn't actively using it, like a child or a deceased person.
And they stitch it together with a fake name.
A fake name, a fake address, maybe a burner phone number. They create a completely new person who doesn't actually exist.
The scary part is what they call the seed phase. Because once they create this ghost, they don't just start stealing immediately.
No, that would trigger alarms. They apply for a small loan or a low-limit credit card, and this is the part that completely fools the algorithms, they pay it back.
They act like the perfect customer.
Precisely. They build a credit score, they nurture this fake identity for months, sometimes years. They are essentially farming trust.
Farming trust? That's wild. And then comes the bust out.
That's the industry term, yeah. One day, once the credit limits have been bumped up to tens of thousands of dollars, they max out everything simultaneously. Loans, cards, overdrafts.
They just drain the liquidity and vanish.
Completely vanish. The bank goes to collect, and they realize they've been lending money to a phantom.
It's incredible to think about the patience required for that. But on the flip side, the sources also talk about how technology has lowered the barrier to entry for other types of fraud. Like, you don't need to be a master criminal or a coding genius to pull this off anymore.
No, you just need a credit card and access to the dark web. We call this crime as a service.
The democratization of fraud.
Exactly. You can literally buy phishing kits that come with email templates, fake websites that look exactly like major banks, and even back-end support.
That's the part that blew my mind. Customer support for criminals. Like, hey, my malware isn't working. Can I speak to a manager?
It sounds completely absurd, but it's a booming business. And with the rise of AI, it's getting dangerously personal. We are seeing deepfakes being used in corporate fraud now.
Like the voice cloning.
Voice and video. Imagine getting a video call from your CFO. It looks like him, sounds like him, and he's telling you there's a secret acquisition happening and you need to wire $5 million to this specific account right now.
And because it's your boss, and he's looking you right in the eye via video, you just do it.
Exactly. We used to call it business email compromise, but with deepfakes, it's evolving into business identity compromise.
Unbelievable. We also can't discuss modern financial crime without talking about crypto and DeFi, decentralized finance. The sources actually seem fairly balanced here. They don't paint crypto as inherently evil, but they definitely highlight the structural vulnerabilities.
The vulnerability lies in the pseudonymity. You aren't a name, you are just a wallet address. And criminals use tools called mixers or tumblers.
Which essentially function like a digital washing machine for money.
That's a very good analogy. You put your dirty crypto into the mixer, it gets pooled with thousands of other users' coins, jumbled up, and then redistributed.
So the coin you get out is not the same coin you put in.
Right. The transaction trail is completely severed.
And then they use cross-chain bridges to hop between different blockchains, just to make the maze even harder to solve.
And they do this often from jurisdictions with very weak regulations, what we call regulatory arbitrage. They set up shop in a country that doesn't ask any questions, but they serve customers globally.
So hearing all this, the speed, the ghosts, the AI imposters, the crypto mixers, my natural reaction, and I assume the reaction of anyone listening, is lock it down. Why don't we just impose the strictest possible rules on every single transaction? Verify everything 3 times.
That is the knee-jerk reaction. But that brings us right back to the inclusion part of our trilemma.
The World Bank perspective.
Right. The World Bank has made it very clear that access to finance is the absolute cornerstone of poverty reduction. If you are unbanked, you are vulnerable. You can't save securely, you can't borrow to start a business.
You're just cut out of the modern economy.
Entirely. Fintech has been a miracle for people in developing economies who might not have a physical bank branch nearby but do have a smartphone. Mobile money changed everything.
But if we apply those super strict anti-money laundering rules to everyone,
then you trigger a phenomenon called de-risking. And this is a really critical concept for anyone in this field to understand.
It sounds very corporate and sterile, de-risking. But the actual impact on the ground is pretty brutal.
It is. Imagine you are a major global bank. You are terrified of getting hit with a $1 billion fine for accidentally facilitating money laundering.
Which happens.
It happens a lot. So you look at your portfolio and you see a segment of clients, maybe it's charities working in conflict zones or correspondent banks in developing nations. These clients don't generate a massive amount of profit, but the cost to vet them and monitor them is enormous.
So it's just a simple cost-benefit analysis?
And the analysis says exit. You don't try to manage the risk, you just cut off the relationship entirely. You de-risk.
So the strict rules meant to stop criminals actually end up punishing charities or migrant workers just trying to send money home to their families.
Yes. And here is the supreme irony of the whole situation. When you kick those people out of the formal banking system, they don't just stop using money, they still need to move funds. So where do they go?
They go underground.
They turn to the shadow economy, they use cash, they use informal hawala networks, and once that money is in the shadows, regulators have absolutely zero visibility.
So by trying to create a perfectly secure system, you've actually driven the activity into a space where you can't see it at all.
That is the paradox. Overregulation can actually make fighting crime harder.
That seems like a massive strategic failure. We created a blind spot by trying to fix a blind spot.
Which is exactly why the regulatory philosophy is shifting right now. We are moving away from the old rules-based approach toward a risk-based approach.
So let's unpack that shift. Because the old way, the rules-based way, that sounds like the tick box mentality we mentioned at the start.
It was incredibly rigid. Obtain a copy of the passport, file Form A, file Form B. Banks were completely focused on the process, not the outcome. They were just generating mountains of paperwork to prove to regulators that they were compliant.
The research mentioned that this led to defensive filing of suspicious transaction reports, STRs.
Yes, defensive filing was a huge issue. If a bank employee saw a transaction that was even slightly unusual, they would file an STR. Not because they actually thought it was criminal, but because they wanted to cover their own backs.
The mindset is, if I report it, I can't be blamed later.
Exactly. So the regulators ended up with millions of reports, most of which were complete garbage.
Just drowning in noise.
It's impossible to find the needle in the haystack when the banks keep dumping more hay on top of it every single day.
So the new way, the risk-based approach, supported by the Financial Action Task Force, this tries to solve that. My understanding from the sources is that the core philosophy here is proportionality.
Correct. The RBA says stop treating everyone exactly the same. A local bakery making cash deposits is not the same risk profile as an offshore shell company moving millions.
Right.
You need to allocate your resources where the risk actually lives.
So spend way less time hassling the bakery and pour those resources into investigating the shell company.
Exactly. It requires banks to actually think and analyze rather than just blindly following a checklist. And alongside this, we are seeing real innovation in regulation itself, like regulatory sandboxes.
I really love this concept. It sounds like a tech startup term.
Because it comes directly from that world. Regulators, specifically the FCA in the UK, was a pioneer here. They realized they couldn't keep up with fintech innovation. By the time they wrote a rule, the tech had moved on.
So they created these sandboxes.
Yes. They allow fintech companies to test new products in a controlled, supervised environment.
So instead of the regulators standing on the sidelines waiting to issue a massive fine when something goes wrong, they are actually in the room.
They are actively collaborating, they watch the product in action and say, okay, this feature is great for inclusion, but it creates a money laundering risk right here.
No.
Let's fix that before you launch to the wider public. It changes the dynamic from adversarial to collaborative.
That collaborative spirit brings us perfectly to the role of technology. Because even with a risk-based approach, the sheer volume of global financial data is overwhelming. We aren't doing this with spreadsheets anymore.
Oh no, we have fully entered the era of regtech and subtech.
Okay, regtech being regulation technology, the tools the banks use.
Right. Automated KYC, biometric verification, and AI that monitors transactions for behavioral patterns, not just static thresholds.
And then subtech is supervisory technology, what the regulators use.
Exactly. And the really interesting evolution in subtech is network mapping tools.
The sources mention this. Can you visualize that for us? What does network mapping actually look like for an investigator?
Sure. Imagine the old way. An investigator is looking at a single bank transfer. Company A sends money to Company B. It looks totally fine.
Nothing suspicious on paper.
Right. But with network mapping, the software pulls back and looks at the entire global ecosystem. It sees that A, B, C, and D are all seemingly unrelated companies, but they're all funneling money into a single hidden node in a tax haven.
And that node is secretly connected to a known sanctioned entity.
Exactly. The software reveals the shape of the criminal network, the whole constellation, rather than just looking at the individual stars. It spots macro patterns that a human brain simply couldn't process.
However, and there is always a however when we talk about powerful tech, the sources flag some really serious ethical and operational risks here. Technology is not a silver bullet.
No, technology is never neutral. The biggest concern right now is algorithmic bias.
Which happens how?
Well, if you train your AI on historical data, and that historical data contains human biases, for example, if certain demographics or neighborhoods were unfairly targeted by banks in the past, the AI will literally learn that bias.
It'll just automate the prejudice. So it might flag legitimate customers as high risk just because of their zip code?
Which leads directly back to financial exclusion. We're back to our trilemma. And then there's the privacy issue, the big brother concern.
The more data we collect to stop crime, the more we intrude on legitimate privacy.
Exactly. We are building massive, centralized databases of biometric data to verify identities.
Honeypot risk.
Yes. If you have a centralized database with the fingerprints and face scans of millions of citizens, that is the ultimate target for a hacker. You can change your password. You cannot change your face. If that biometric data is breached, the consequences are permanent.
That is a deeply sobering thought. So we have highly sophisticated, fast-moving criminals. We have a real moral obligation to include people in the banking system, and we have these powerful tools that carry their own massive risks. how do we actually move forward? The research suggests that the lone wolf approach is just completely dead.
Completely. The days of banks working in silos are over. Think about it. Criminals are global and they're highly collaborative. They share tips, they share malware tools, they move across borders seamlessly.
Right.
Meanwhile, banks and regulators have traditionally been trapped within their own walls, terrified to share data because of strict privacy laws or competitive advantage.
So a criminal could get kicked out of Bank A, walk down the street to Bank B, and start all over again because Bank B has no idea what Bank A knows.
Exactly. And this is why the sources heavily emphasize public-private partnerships, or PPPs.
Right.
We need legal frameworks where banks can share intelligence with each other and with law enforcement without violating privacy rights.
The material outlines this 3 pillars framework for the future of financial crime management. I think it's worth spending a moment on these because they really do synthesize the whole solution.
It's basically a tripod. You need all 3 legs or the whole thing falls over. Pillar 1 is innovation enablement.
Meaning we can't stifle the technology.
Right. We have to let the good guys innovate just as fast as the bad guys, let the new tech grow safely.
Which means using those sandboxes and testing new ideas together.
Exactly. Pillar 2 is risk-based controls. We have to be smart about who we monitor. We stop ticking boxes and start analyzing real threats. We use data to focus on the high-risk actors and leave the low-risk people alone.
And pillar 3.
Collaborative intelligence. This is the hardest one culturally. It means breaking down those silos. It means sharing data so we can see the full picture. If we can't collaborate, we will always be one step behind the networks that do.
There was one final concept in the reading that I found really compelling. Embedded integrity. It sounds more like a product design philosophy than a banking rule.
It is a design philosophy. For a long time, compliance was seen as the Department of No. It was a group of people in the basement you only called when things went wrong.
The fun police.
Right. Embedded integrity means that financial crime prevention can't be an afterthought. It must be baked into the product from day one, by design.
So when you are designing the app, you are simultaneously designing the shield.
Exactly. You don't build a fast car and then try to tape the brakes on afterward. You build the braking system as an integral part of the performance package. Growth and security can no longer be viewed as separate things.
If you try to scale a fintech product today without a robust integrity framework built in, you will crash. You will either be overrun by fraud or shut down by regulators.
There's no third option anymore.
It's a really powerful takeaway. We are moving from a world of defensive, reactive paperwork to a world of dynamic, tech-led, collaborative intelligence.
We have to. The landscape has fundamentally changed, so the map has to change with it.
Well, this has been an incredibly comprehensive look at the state of financial crime. I mean, we've gone from the speed of digital laundering to the paradox of inclusion and de-risking, and finally to this new model of collaborative defense.
It's a fascinating field. It's an arms race, really, and it never stops evolving.
It really doesn't. Before we sign off today, I want to leave you with a thought to mull over. We talked a lot today about how technology acts as both a shield and a risk. As we rush toward this new world of completely AI-driven finance, are we building systems that are truly resilient? Or are we just building faster, more efficient ways to make the same old mistakes?
That is the question that should keep us all up at night.
Thank you so much for listening to this analysis. Remember to take the quiz to claim your CPD certificate. You have certainly earned it after navigating the complexities of the modern financial underworld with us.
Until next time.
Bye for now.